This is A Tax Lawyer Answers the Internet, Part 2. My name is Edward Collins. I'm a lawyer specialized in tax, estate, and business law. I'm also a serial entrepreneur, building and scaling my own companies for the past 26 years, helping business owners just like you to do the exact same thing. Now, if you haven't watched Part 1, definitely jump over to watch that. But if you are here and you've already seen that, let's dive right into some more questions that business owners have that matter. How can you use real estate investing to offset your W-2 income? Well, the only way to do that is by leveraging something called the passive activity loss rules exceptions. Real estate, by default, is considered passive activity. And after 1986, there was a rule put in place called the passive activity loss rules, which essentially limit your passive losses to only be available to offset passive income. And while that by itself is very good because it can reduce the income tax that potentially is associated with any rental income that you get, many investors would love to be able to pull those losses, which oftentimes could exceed your rental income due to something called depreciation. They would love to be able to pull those losses over to the non-passive side to reduce your W-2 income. In order to do that, though, you have to qualify for one of the exceptions, and there are two main ones. The first one is called the real estate professional status, and that doesn't mean becoming a realtor. It simply means under the IRS's viewpoint, you're engaged in one or a combination of 11 different activities that qualify as the trade, meaning the active trade and or business of real estate. And if you do that, plus you invest at least 750 hours doing those activities in any calendar year, and it's the primary activity that you're engaged in, well, then you could potentially qualify as a real estate professional and get this particular exception. Now, I want to be very transparent. For W-2 earners, this is pretty darn hard to qualify for, specifically because of that 50% or more of your activity. Because if you're a W-2 employee working at least 40 hours a week, well, that would mean you'd have to spend 41 hours a week, or at least some derivation thereof, actively engaged in the real estate trade or business, and most would not qualify for that. So the second exception is likely the one that most W-2 earners could actually take advantage of, and that's the short-term rental exception. In this particular case, this gives you the ability to leverage those losses against your W-2 income by qualifying with short-term renters, meaning the tenants who are going to stay in that property on average stay 7 days or less, and you're investing at least 100 hours in a calendar year, but no one else can actually work more than you do in that particular business. But if you do meet all of that criteria, you have the ability potentially to qualify for that particular exception. And why would someone want to qualify? Well, potentially it could reduce significantly your tax burden, so it should be explored. Should you sacrifice your survival funds to invest in real estate? Well, my very straight answer is absolutely not. But it's a bit more complicated than that because you really want to do the proper analysis of determining exactly how much survivor funds you should have on hand. You see, there are a lot of different rules of thumb, anywhere from 3 months to 6 months worth of liquidity in the event of something like a job loss or some other economic hardship that you suffer. Now, once you've calculated what that number is, well, then you should absolutely safeguard it. It's there to be your safety net. So if you were to tap into that to try to take some sort of risk that's associated with generating either the creation of wealth or the accumulation of wealth, or at the very least, the accumulation of cash flow options, I think that's a risk you should not consider. However, once you've calculated an amount that is in your safety net and you're safeguarding that, all of your excess capital 100% should be given a job. Because if you don't give your dollars a job, they become the employee of someone else. What considerations play into decisions regarding IRAs and tax deferral? The biggest consideration is whether or not tax deferral is the driving factor. You see, when you make a contribution into a traditional IRA, as an example, those dollars do result in a reduction of your taxable income, meaning lowering your tax bill in the year you make the contribution. But those dollars, when you take them out in the future, will be income taxable to you at that future time. And depending on what tax rates and where tax rates are at that future time, well, the decision to defer today to pay it in the future may not have necessarily been the right one. The real consideration is when you're looking at your overall financial picture, is there a need for tax deferral or tax-free growth? There is an alternative to the traditional IRA approach, and that is something called a Roth IRA. The Roth IRA essentially does not give you a tax deduction when you make a contribution into it, but those resources will grow tax-deferred and be available tax-free in the future when you do take money out. There are limitations, specifically in the realm of income that allow you to be able to qualify to make contributions, but there's a workaround. There's something called a backdoor Roth, and that's when you make a contribution into a traditional IRA, essentially getting a deduction, but immediately convert that traditional IRA into a Roth, negating the deduction. This is an interesting loophole that currently exists in the tax law and may not be open forever. So if you are interested in taking advantage of it, you may wish to jump soon. If you form a holding company in one state that is not the state that you're domiciled in, what's required when it comes to filing taxes? Well, if you want a rule of thumb, I can give you a rule of thumb. If you want a formula, I could give you a formula. But if you want the real answer is it depends. What type of company are we talking about? You see, when I use the phrase holding company, that's simply just a term of art. There's nothing in the law that says what a holding company is. When I use that phrase, I'm simply talking about a business entity of some sort that has been designed and formed to own other things, whether those are real estate assets, portfolio assets, or even business assets. In all, though, there's another question that needs to be answered about that holding company. What type of business entity is it? For instance, if it is an LLC that is disregarded, well, an LLC that's disregarded is a pass-through entity. It passes everything on to whoever owns it. So it does not file its own return. And since you do not reside in that particular state, you reside in another, all of the income is going to be passed on to you in the state in which you are domiciled. And that's where you will file the tax return, meaning your personal tax return for that income that it's generating. That business, however, could potentially be formed in such a way where it is required to file its own tax return. For instance, if it was an LLC that elects S-Corporation treatment, as an example, well, that LLC would need to file its own tax return. It's called an 1120S. And it would file a tax return at the federal level and possibly at the state level if that particular state has a requirement for business entities that are S-Corporations to file tax returns. For instance, if you were to file, or form, I should say, an LLC that is electing S-Corporation treatment in Wyoming, as an example, and that's your holding company. Well, Wyoming doesn't have an income tax at the personal level, and it doesn't have a corporate tax. So that Wyoming LLC, even if it did elect S-Corporation tax treatment, well, it would not file a tax return in Wyoming. It would still, however, file a federal tax return, meaning an 1120S, and it would report that income to you personally. Let's say you lived in New Jersey. It would report that income to you personally via a K-1 in New Jersey. Now, if it owned a business, meaning that Wyoming LLC owned another LLC as an operating company in New Jersey, there is the potential that New Jersey would tax that operating entity. Again, depending on how it's formed and the type of business activity it's engaged in. When you're really trying to figure out what is the most appropriate approach for you when it comes to filing your returns, because that is a compliance requirement. You guys know that I hate the IRS with a great passion. I hate all taxing authorities. But in the end, you want to make sure you're being compliant, because at the end of the day, they have guns, and I don't want them to come after and take your stuff. So meet with a qualified professional that can give you personalized guidance so that you can do what's correct when it comes to filing. So what are the limits to tax deductions? That's a complicated question because there are so many different types of deductions that are available on tax returns, whether we're talking about personal tax returns like your 1040 or even business tax returns like 1120Ss and 1120s. When it comes down to it, we have to really analyze the type of deduction we're talking about. If we're talking about IRA contribution deductions, for instance, well, there are dollar limits with regard to the amount of money you're able to contribute into a particular IRA, a traditional IRA, in any given tax year. Now, when it comes to things like Schedule A deductions, for instance, with regard to state income tax and property taxes, there's something called the SALT limitation. And in that case, it doesn't matter what your total state income taxes and state property taxes are. The maximum you're able to deduct under the SALT limitations is $10,000 in any calendar year. Now, there are also limitations when it comes to businesses deducting business expenses. Those limitations may not necessarily be in dollar form, but in substance, meaning you have to qualify under a two-part test called Section 162A of the Internal Revenue Code, and that's the ordinary and necessary section. The business expense must be both ordinary, meaning normal in the area or industry in which you were engaged, and two, it must also be necessary. And necessary simply means required for the pursuit of revenue generation. And If you meet both of those tests, it is likely that the underlying business expense could be a legitimate deduction. In all, there are so many different types of deductions that are possible, and it can be quite confusing, but what I'm not confused about is your ability to deduct the up-level community. When it comes down to it, getting the right answers to questions just like this, well, oftentimes it means you have to be in the right rooms with the right people, asking the right questions to get the right answers so that you can start taking action on those particular answers that you get. And I have such a room. It's called the Up-Level Community. It's a private membership community filled with business owners just like you who are all interested in the same things, taking your lives and your businesses to the next level. So go ahead and make your decisions regarding where you allocate your dollars, make them wisely.